Hello friends, welcome to my YouTube channel on Valuation Beta Academy. In today's session, we cover the concepts of IRR and payback period. And when we look at IRR, we look at both the project as well as the equity IRR. As the motto of this channel, we are not just going to cover the theory behind how these are, what is the theory or just a technical understanding of these concepts, but we are also going to spend a lot of time in behind the practical approaches as well. So how do you model them in Excel? What are the challenges which you can face and what could be the various scenarios? So we are going to learn a little more on that as well. So without much ado, let's get started. And on the first, let's cover the basic concepts of IRR and payback period. So what is IRR? So IRR is a measure which is used to understand the profitability of an investment. If a company has an option to invest in different kind of projects and wants to compare what is the return which these projects could generate over a period of time, IRR could be one of the measures that it could be used. So what does it do? It is the time at which the net present value of the cash flows equals 0. So when we discount the cash flows with the IRR, you'll get a NPV which is 0. And as said earlier, it is used for comparing different investment opportunities. And always it is a good idea to compare the IRR along with the discount rate. So typically when we say that the IRR is more than the discount rate, it is the time when the investment could generate profitable returns and make sense to get into that investments. And a similar concept along with IRR is the payback period. So what exactly is the payback period? So payback period is the overall time which takes to make the return the initial investment cost. So what is how much time will the cash flows be enough to generate or recover the initial investment? So one thing that payback period does is different from the IRR is the payback period looks only at the time till the overall cumulative cash flows equal the initial investment. It does not take into account the cash flows after the when the initial investment is recouped. But IRR takes into account the cash flows right from the construction stage to the operation stage and till the end, till the project becomes sustainable or the entire project life is taken into account. So this is one of the differences between the IRR and payback period, but typically both these matrices are calculated parallelly on a project. There are two different kinds of IRRs. One is the project and the other is an equity IRR. Very few people will actually cover the concepts of project or equity IRR, but it's very relevant if you are trying to make a career in modeling in Big Fours or in corporate finance or in commercial banking space. So what is equity IRR? In simple terms, it is the IRR which is meant for the equity investors. So what you need to do is you need to take into account the cash flows which will be only attributable to the equity investors. What could be these cash flows? They could be the dividends which are paid to the equity investors over the life of a project if there is a structured dividend payout policy. If not, then we need to look at some of the free cash flow calculations to come up with the equity cash flows. Same thing when we look at project IRR, it just does not take into account the equity investors. It looks into all sources of capital, be it debt, equity, and if even there are preference share capital, we take into account the preference share capital. And then it again, as mentioned earlier, the project IRR will look into not just the equity investors but with also the debt investors. An interesting question: what is higher, equity IRR or project IRR, and what could be the scenario when project IRR could be more than the equity IRR? So what we typically see is that the return required for the equity investors exceed that of the overall project IRR because of the risk aptitude of the equity investors and the lower cost of debt of the lenders. But at the same time, there could be a situation where the cost of debt itself is more than the project IRR. So in that case, you'll have a project IRR which is more than the equity IRR. Or we need to look at the capital structure. So what do we mean by capital structure? It is the debt to equity ratio. So overall, if we see a higher debt to equity, debt as compared to equity in the project, along with a higher cost of debt, so that could be the situation where the project IRR lands up being more than the equity IRR. So that's it from the theory perspective. So stay tuned. We'll move to Excel and just try to see how do we cover these concepts in practice. So and in the meantime, if you like this channel, then do please like, share and subscribe and comment, but stay tuned for how do we do it in Excel. So guys, let's get started. So what I have right now with me in Excel is a sample income statement, which you'll typically find in most of the IFRS accounts, as well as a simple balance sheet. So before deep diving into the concepts, maybe this is, to give you a background about this P&L and the balance sheet. It is of a hospital, so you could have sensed it from the revenue contribution, which is from consultation, day surgery, diagnostic and pharmacy revenue. And we have put the the direct costs attributable to the various lines of business, for which we get the gross profit. And then we have certain overhead expenses, mostly related to the salaries of the clinical, non-clinical and the general admin staff. And finally, we have the other operating expenses. We deduct other operating expenses and the overheads from the gross profit, and we come up to an EBITDA. And we have the EBITDA margin, depreciation, interest. We get to the earnings before taxes. Then we have the taxes, and finally the net income. And if we look at the balance sheet also, we have certain fixed assets, working capital, liabilities, and then we have the equity investments. If you look at the structure of the P&L, it looks quite well structured, right? So you have the cash flows, the time period, and everything is quite dynamic. So we have the starting period when there is, if you would have noticed, there is a construction. So let's assume it takes 3 years to construct this hospital. And then there are 10 years of operations. So it takes, we have shown the cash flows or the financials for 10 years. So by the end of 10 years, it is assumed that the operation business becomes stable, and we have the cash flows which would happen on a recurring basis. Similarly, when you see we go to the balance sheet, so what we have done is linked the period counters from the P&L sheet. So this is a good modeling practice to always have. So when you have a certain timeline which you need to put in, you need to link it from one place. So if I want to make changes in just one place, I have it at all the worksheets. So I don't have to change it in all the worksheets. So try always doing that. So we have the formula here. So when we put the year in this cell, it will pick up it will just format it as FY23. So how do we do this? So we just use a simple formula, and then we find out financial year end ampersand year, and then we find out the year which it is into. And if we put this formula, it gives us FY 2023. But I just need 23 and not 20. So then I again just modify this formula and write it as right, 2. So it will give me FY2, and I just drag it. So it has given me, and then I use the end of month to come up here the year end dates, and then a period counter. What I have also done over here is pre-calculated the working capital, which is, when we look at working capital, we just now have accounts receivables and inventory. And then in current liabilities, we have the accounts payable, other current liabilities and taxes which are to be paid. And again, No, there could be in a practical scenario a lot of other current assets like prepaid expenses and tax receivables and stuff like that. So, but you need to see what are part of the business operations and what could be classified as working capital. So you need to include all these in the working capital changes. So why do we need working capital? We'll come back to it once we start calculating the free cash flows. And if you look at the balance sheet right now, we have the land. So there is a construction period. So first year I have not intentionally taken any cash flows. So if you see it as zero, net income is zero, in the balance sheet also there is nothing. I'll come to it why I have done that. And then if you look at the first 2 years, there is a certain land and certain fixed assets investments which have been done in plant machinery, in buildings, in consumables, and it has been funded by debt. So there is a senior debt which has been taken. There could be other sources of debt as well in practical scenarios. There could be some revolving credit facility or certain other debt components. We have just assumed that there will be just one senior debt which has been taken, and then there is a capital equity infusion which has happened through the form of share capital. Next year we see further investments in fixed assets, so it has gone up from 70 to 100. So there is a capex of 30 million which has happened. For that, there is a debt of 15 million which was taken, and then there was further equity infusions of 65 million. And finally, there will be certain investments which are required for running the business. So that's why we see that comes through mostly in the form of debt and equity, because once we start a business, initially there are going to be, it may not be really profitable, and investments will be required in working capital and other items. So there could be need for further equity infusion. So we have assumed equity and debt infusion in that. So what I would also need is the capex. So how do I get it from the balance sheet? A P&L, I have the P&L and a balance sheet, and if I want to understand what is the capex, how do I do it? So one way of doing is creating kind of a capex schedule. So this formula looks, how do I do that? So is my capex, when I look at the balance sheet, is it 100 minus 30 in the first year? And then if I so if you see that the capex is becoming negative, but that doesn't mean that why is this negative and this positive? Because this also includes a component of depreciation in it. So there is a 5 million depreciation which is included over here. So that's why it is coming up as a negative amount. Don't worry, I'll also share this Excel workbook with you once I'm done with the session, so you can always look on it on how do I set up this block. So there will be an opening gross block which will be equal to the previous year's gross block, and then I need to take into account what is the fixed assets. So when I look at, and then I need to subtract the previous year's fixed assets, correct? And then I need to take into account the, okay, so this needs to be, the depreciation needs to be added here, and then we just stretch it. And here we have, so we have 100 million of capex in the first year, and then 30 million, and after that it is 0. And then there is a line for depreciation as well. Maybe we just call it depreciation instead of accumulated depreciation. So next step is I'm gonna create the free cash flows. So how do I do that? How do I calculate IRR and NPV in this? So I just create a copy. So I don't start from a blank worksheet. So what happens is, if I have to start, if I could have created a blank worksheet and could have done the calculations, but at the same time I would have to reformat it. So that would have taken me a lot of time. So I don't use a blank worksheet, and neither should you. Let's rename this worksheet as free cash flows. And then now I don't need the balance sheet, right? So maybe I just straight away delete it, and I need to name it as free cash flows, or let's name it as Project IRR calculation. So what do I need for Project IRR? I need the cash flows which are attributable to the entire project. So we need to understand the concepts of FCFF, which is the free cash flow to firm. So I need the revenue, I need EBITDA. Maybe I'll just format this a bit so it becomes easier to work with. I just do control copy and then do control alt est, revenue, EBITDA. Let's then I need to deduct depreciation from it. So depreciation, I'll come up with an EBIT. Then I need to calculate taxes on it. So less taxes on EBIT. I'll also need the working capital changes. And then I'll need finally the capex amount as well. So I already have this line items in mind. So one way of doing this is, if once you are watching this video and you have access to the the file, so you can do this calculations along with me. So this will also help you, do it in a real-time basis. So I have the revenue, then I do the EBITDA, for the 10 years, then I do the depreciation, which is row 41, and then I need to calculate the taxes on EBIT, and this will give me the EBIT, which is the same as that in the balance sheet or in the income statement. So we have 214 and 271, so we should have the same numbers here, and I'll just format it. So control copy, we just format. Always when you are working Excel workbooks, you need to learn to have good presentation skills. So your Excel should be really good looking, and it should be easy to understand as well. So I need to consider now calculate the taxes on EBIT. So when we look at free cash flow to firm, the taxes are always on an EBIT. So we need the tax rate. Now for the business which you want to calculate the IRR, so you need to know what is the the tax rate which is used. And let's say the tax rate is 20%. I just extend this column a bit. So I'm using a tax rate of 20%. You need to look at which country the company is based out, or what is the marginal tax rate which is followed for the company, and accordingly calculate the taxes. So easy way is to multiply, and we fix this, so you can end up with so this is how. Another way of going wrong is like, what happens if this is minus 20? So this becomes 4, which is not correct in this case. So we need to change this formula so that if there is a loss in any specific year, there should not be any taxes which are paid, in simple terms. So maybe I use a formula and say that max of this is 0. So if you see, if it is minus 100 here, so it won't calculate any taxes. It will calculate taxes only once there is a profit. I have already done the working capital changes calculation over here. So I just need to link it. If you are doing it from for your own calculations, you need to separately calculate the working capital changes as well. I have the capex here. So I look at the capex calculation and I get the capex. So this gives me free cash flows to firm, and I need to format it. So I'll put a double line, which is the total. And what is free cash flow? It is EBITDA less taxes on EBIT, less working capital changes, less capex. Now this is the free cash flow to firm, but what happens to the operations after FY35? So after FY35, it is assumed that the business becomes stable. I've taken a 10-year period. It could be 5 years for some businesses. It could be 3 years. But you need to really sit with the management or have a good understanding of the business to understand what is the overall life cycle of the business. So once it stabilizes, we need to calculate a terminal value to it. So let's call something as terminal value adjustment. So how do we calculate terminal value? There could be at least two methods which are very common. Look at the free cash flows in the last year. You capitalize that free cash flows. How do you capitalize it? You take the free cash flows divided by the discount rate minus the terminal growth rate. Another simple method to use is to use a multiple, say a EBITDA exit multiple. In this case, we say let's take an exit EBITDA multiple of, let's assume 10. Now this again, you need to benchmark it with the comparable companies, look at what the companies or what the investments in this industry has happened and what is the multiple which the investors have exited it, and then use it accordingly. But for simplicity, we are assuming an exit multiple of say 10. In this case, and we come up with an exit multiple here. And then we look at 24. And finally, we have the free cash flows. Now, these are the free cash flows for the entire project. We need to look at the investments which have happened. So we had the senior debt, right, in the balance sheet. So senior debt drawdown. And we had the equity investments. What is the senior debt drawdown in this case? In the first year, it is 0, correct? And we put a negative sign to it. So what we need to just take into account is the investments in the business, and we do not need to take into account the repayment of debt. So only the investments which we need to take into account. So there also has been a certain repayment which has happened in the later years, which we should not be taking into consideration when we calculate the project IRR. So we need to put a formula for it. So we use a min formula in this case, so minimum of 0. Same thing with the equity investments. So we have two components here: statutory reserve, which is required for the business operations and from a statutory perspective, and we need to see how much. So we just do a good modeling practice is to always have only one unique formula across the row. You should not be changing them. So that's why if you see, I have created a separate buffer column over here so that I don't change the formulas. Had I not had column C over here, then I would have had to break this formula, which would not have been the right thing to do. So that's why the entire idea was to have a buffer column initially. And that is something which you should also be doing that. Total investments. So I've looked now at the total investments and I do a sum of it. And we get to the total investments here. So now we have free cash flows and we have the investments, project investments. And basis for Project IRR. And again, I'll just format it a bit. So what is the free cash flows? I have it here. I have the basis for the investments, and then this too will give me the basis for calculating the project IRR. So quite straightforward, and then I calculate the project IRR. So what is the easiest way to calculate the project IRR? The easiest formula is to use the XIRR formula here. And I use the XIRR and I look at the dates at which, and I fix these dates. And I do a percentage calculation here. So if you see, the value is 0%. So what could have gone wrong over here? And if I do an XIRR and if I take the dates from year to year. So if you see, the project IRR is 26.5, but in this case it just gives me 0%. So there is a mistake, right? Actually, it's not a mistake. It's the way in which this Excel formula XIRR works. So there is a 0 over here. So had this 0 not been there, then we would have still managed to get some values. So which does not seem to be the case. Easiest way to fix it is to use a if-else formula here. So if this plus this is equal to 0 and this is equal to 1, I combine it with the AND, then I put a simple, take say very minimum values, 0.001 else D31 plus D32, and I do this. Still it doesn't give me any values. So instead of positive, we need to add a negative, and you'll see you'll get a project IRR here. We just align the formatting so that it becomes a little better. So this is how I got my project IRR. Another way of doing it is using goal seek. Maybe you can wait and watch till the next session. We'll cover some concepts of goal seek as well. So another way of calculating XIRR is using the Excel goal seek formula, which you'll find it in the what if analysis section under the goal seek option. So guys, once we are done with the project IRR calculation, what we can do is move to the equity IRR calculations in the next table. So I can just paste it here, equity IRR, adjust the row width. What do I need for equity IRR? I need the free cash flow to equity. In this case, I do not have any dividend payouts which are happening over the project cycle. So I need to look at a proxy for it, which is the free cash flow to equity. And what do I need for free cash flow to equity? I need net income. I need to add back the depreciation. I need to take into account the working capital changes and the capex and debt repayment additions. And I just format all these rows so it's consistent. And just like the free cash flow to firm, we use also terminal value adjustments. So we have the net income, we add the depreciation, the sign will be positive because we are adding it back. We need to look at what is the working capital changes. If there is an increase in working capital from 35 to 37, that is $2 million of investments which are required, which will reduce the free cash flows. Hence, the working capital changes will be negative. And then we need the capex. So if you have seen, what I've done is I've linked it to the balance sheet and the income statement. What I could have done is linked capex to, so this should be actually coming up here, and then I could have linked capex to the section above over here, nothing wrong, but a modeling best practice is to always link it to the original source of data and not through the section above. Although it's much easier to do it, the challenge is that it is called a daisy chain. So what happens is, if I link it to this section here, just now what I've done, and if I make any changes in this table, or if I maybe delete this row or make any formula changes here, this will also get impacted and it might lead to errors. So always use the source, which is the original source, and link it. We already have the debt repayment, so I link it to the debt. I need to just make a change to this formula. So 50 million of debt which is taken, which is actually increasing the free cash flows, and in the later years the free cash flows reduces as the debt repayment happens. And just like we have made adjustment for the terminal value, which is based on an exit multiple, so we also do an adjustment for the net income multiple. Practically you need to be consistent with the multiples which are used. So either you can use an exit multiple which is consistent in both the scenarios. Best way is to capitalize the free cash terminal value cash flows to come up with a terminal value, or you can use a multiple which is based on the comparable companies or transactions. So I have used an exit multiple here. And finally, I have the free cash flow to equity. So I just need to sum it up. I'll format this a bit. So if you see, my worksheet is really well formatted. Always try to achieve that in your the models which you make. And finally, I can just copy paste this. So I have the FCFE, I have the equity investments, basis for equity IRR, and finally I have the equity IRR. Free cash flow, I need it from this table here. I have the equity investments. Where is the equity investments here? So I just copy paste this formula. Again, I did not use the same formula. I use the same concept of trying to avoid an error in the XIRR calculation. And I finally come up with an XIRR. I format it again, remove just the. Likewise, I can also do the project payback period, and I name it as project payback period because I need to take the cash flows. I am calculating the payback period for the entire project and not just for the equity investors, but the approach is very similar. So what do I need for the payback period calculation? I need the free cash flows, I need equity investments, and then the cumulative cash flows. So what are my free cash flows here? Free cash flow to firm, which I have calculated here, and I need the total investments. I look at this as project investments and not equity investments. I just copy paste this entire section and format it alt est, and finally we have the free cash flows and then the cumulative. So how do we calculate the cumulative cash flows? Easier is like this plus this plus this. This is one way of calculating the cumulative cash flows. But if you see, there will be a certain career formula break, so I cannot use the same formula in column C. Nonetheless, I don't need it, but a better way of modeling is to use, did you understand? Like, you cannot see, once I paste this formula, I cannot have the same formula in all the cells. So I need a formula break. So my formula changes from here, it changes to here. So instead of this, what do I do is I use a basic sum formula, but I fix column T in this F4. And I get my cumulative cash flows. Then I use something called as a period counter to understand, and finally the payback period. My payback period will be the sum of all the period counters. So I'll come to what this period counters actually mean, and maybe I'll just format it here so it's much easier to understand. So what is the payback period in this case? Simple terms, it is 9 years of payback period because the cumulative cash flows here turn positive from minus 113 to 23. So the payback period is 9 years. I don't take the first year construction year, I just shown it to you so that you could understand how the XIRR could lead to a formula error and how you could fix it. So there are 2 years of construction which is happening. So my period counter will be 9, 1 in each of this case, and then there will be a certain fraction of it. Say we take a percentage of what the cumulative cash flow is and as a percentage of free cash flow, and it will come up as 0.83. So my payback period is 9.8 years. Now how do I put a formula for all this so that I can use the same formula across the row? So now I need to set up a formula for the period counter, and let's do it for for the first stub period, which is 23. So if my previous year had been positive, then I don't need a calculation for a counter, so it has to be 0. If my current year is negative, then I take a stub factor of 1, and if it is like first time turning positive, then I just do a fraction of it. Yes, and that's how, if you see over here, we get the period counter factors. And if I do it for the first year, I'll get a high divisional error, so I just need to use if error in this case and fix it up. And I just copy this formula here at the top row and just drag it there. So that's it. So this is how we come up with a payback period. So in today's session, we have covered equity IRR, project IRR, and the payback period. Hope you have all liked this session, and if you have any feedback, please put it down in your comments. Till the next time we see each other, wishing you all a good day ahead, and See you next time, and if you like the content, then like, share and subscribe.